Welcome back to another episode of Not Financial Advice. This is Sean, and today we're going to be taking a look at Netflix stock. First, let's do an update on how my portfolio has performed today. It is Tuesday, January 23rd. We have about 15 minutes until the market closes at this time of recording. I am up about $190 or 0.28%. The S&P 500 is up about 0.2%. The Dow Jones is down 0.3%. The Nasdaq is up a similar amount to my portfolio, up 0.28%, and the small cap Russell 2000 index is down 0.1%. What we often do here is take a look at my top five best performing stocks of the day. So we'll do that now. We have Procter and Gamble up 4.1%. Then Estee Lauder up 2.6%. Up 2.5% is Wheaton Precious Metal. Church and Dwight is up 1.9%. And we also have Boston Beer Company up 1.8%. So a pretty defensive day in the stock market. Now let's look at the bottom five decliners in the portfolio. And so what we have is Johnson & Johnson down 1.5%. Down 1.6% is Home Depot. Green Thumb Industries is down 2.4. Coinbase is down 2.7, and 3M is down 11.4 as well. And so, yeah, as I mentioned, today we're going to be taking a look at Netflix stock. We're going to look at some of the pros and cons behind Netflix as a company. And by the end of the video, we're going to have a rough estimate of what Netflix shares are worth. So I'll ask you to like the video, subscribe to the channel. As always, if there's a stock or an ETF you'd like for me to review, go ahead and leave that in the comment section down below. Type its ticker down there, and we're going to get started right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Okay, so here we are looking at an all-time chart on Netflix and its stock performance. Up a lot, 41,000% overall time. You can see here over the last 5 years, it was really on a huge run. It went up 100%, and then there was a big drawdown. This is around the time that I became really interested in it, down 74%. And then since that time, the stock has raised 160%. So there is quarterly earnings being reported on this company right now. I'm not going to be making a prediction on that. What we're here to do is to get an idea of the fair value of Netflix per share. So now what we're going to do is go over here and look at some different pros and cons behind a Netflix investment, at least the ones that I took into mind. So the pros for Netflix, I think they have a content moat. What I've always said about Netflix is they have such good content, it can make me emotional. If you can make someone laugh or smile or cry, that's a very powerful product that you have, and Netflix certainly has that. So another pro for Netflix stock, I believe it's the last streaming service that people would get rid of. They also have their new ad tier program, making it more affordable for people of different income levels, cracking down on password sharing and then pricing power. Because of all the reasons above, they're able to increase their prices, pass on price increases with inflation, or when they have higher expenses. So some cons on Netflix as an investment. There is some competition. An argument could be made, how much more can they grow, especially in the United States? They've struggled with free cash flow in the past, and at the end of the day, it is a discretionary purpose. And so in a deep recession, they could see people cancel their subscriptions, although I think a lot of people might just downgrade to that ad tier. So not trying to be too biased there, but let's get over to Qualtrum, and we're going to look at some of the facts and figures behind Netflix stock. I'll ask you to like the video and subscribe to the channel, and remind you, as always, Qualtrum is a stock site that I look at. I pay for the service, but I'm not affiliated with Qualtrum. So I'll leave a link for it in the description below. Let's take a look at our different checks and minuses today for Netflix stock. And when we're looking at revenue, that's a great looking revenue growth chart. In the last 5 years, they've grown at 14.9% a year. This is a strong check mark. Looking at free cash flow next, this is an interesting looking chart. So they do some stock-based compensation. It's not the best, it's not the worst. So let's look at stock-based compensation adjusted free cash flow. And so over the last 5 years, they've had 2 years that were positive with free cash flow and 3 years that were negative. So they've done $1 billion in cash flow. They've done $1.5 billion in cash flow. They've been down 500 million. They've been down 3.6 billion, and also have been down 3.2 billion. Let's get in here and look at how the more recent quarters have been performing for this company. And so, looking at this on a quarterly basis, we can see we have the last 1, 2, 3, 4, 5, 6, 7. 6 out of the last 7 quarters have been positive, and it's growing in magnitude. If you can see how much they were losing here, it's a similar amount to what they were gaining here. So, on the whole, I'm going to have to sort of normalize and smooth things out for our free cash flow um, number. But going back to the annual chart, I'm going to give Netflix a tepid check mark on free cash flow. 6 out of the last 7 quarters being positive are definitely a sign of good things in the future and that Netflix has got to scale. So let's take a look at their earnings per share. It's up and to the right in a big way. That's going to be a check mark. Looking at Netflix on cash and debt, um, they've had more debt in the past than they do today, and it looks like they're working to pay that back. They've been holding the cash levels fairly steady. Let's go on the quarterly basis and see how things are shaping up in recent times here. And let's just look over the last 5 years. So over the last 5 years, the trend is debt essentially stable and cash reserves going higher. So I'm going to give this a check mark. It's not the best looking chart I've seen for cash and debt, but all the same, it looks like things are pretty well under control. And so I will be giving cash and debt a check mark. The company currently does not pay a dividend. Looking at shares outstanding, they're essentially flat. I'll give this a neutral rating. For Netflix, looking at returns on capital employed over the last 10 years, we can see sort of a median number around 10%. That's pretty okay. So I'll give it a check mark. Looking at their bottom line profit margin, this is definitely getting into that tech category for bottom line profit margin, over 10%. So I'm going to give this a check mark as well. Would definitely like to see that a little bit higher, but we'll get there. Now, valuation, let's look over the last 10 years for Netflix. They're trading at a historically low PE multiple, so that'll be a big check mark for me. And then lastly, we're going to take a look at expenses. In the last full fiscal year, it looks like they had about $6 or $7 billion of expenses. And when it comes to revenue, they had a good amount more revenue than they did in expenses. Um, Although the expenses were more than the free cash flow. Um, let's take another look. Sales and marketing is their biggest expense. I'm just going to give this a neutral rating. So let's move forward now to our free cash flow estimate on for fair value rather on Netflix. We have a $492 stock. Okay, so here's what I've done. I think Netflix is a story of a technology company that's gotten to scale and will now remain profitable. So I've had to make some assumptions, and that weighs heavily on the conclusion that the DCF estimate presents to us. But what we can see here is looking at stock based compensation adjusted free cash flow on a quarterly basis over the last 10 years, we can see. That in 2014 they posted a narrow loss, and their loss has accelerated into 2019. And so this is building studios, buying the rights to things, growing the staff, making acquisitions, all that sort of stuff. But we saw something turn around in the beginning of the pandemic that has not faded away. And as you can see, the trend line from 2014 to 2019 was down and to the right. You can see from 2020 to late 2023, this trend line for free cash flow is up and to the right. So what I've done, taking a little bit of a license with this, is I've looked at the free cash flow over the last 5 quarters. So they had 5 consecutive quarters in a row with positive free cash flow, and we can see 1.81. We can see 1.26, 2.020. We can see 178 million, and we can see 320 million. What I've done is I've averaged these 5 quarterly numbers, which was essentially 1.17 billion. And then what I've done is, after averaging these 5 quarters, down to just under 1.2 billion. I went ahead and times that for 4 to come up with a projected free cash flow that I think can be realized in the next few quarters or the next year. And so that would put a projected free cash flow of 4.5 billion dollars a year in free cash flow. These numbers are from the most recent quarters in Qualtrum for cash, debt, shares outstanding. Because I've had to project free cash flow, I've also needed to be pretty conservative in the growth rates. And so the growth rates are going to be staying the same for both of these two sort of models, but I've projected the growth rates for the next 5 years at 12.5%, down to 7.5% for years 6 through 10, a terminal growth rate of 10%. If we needed a 10% return, a 10% discount rate, this stock, which I believe is trading in that 470 range, its value would be only 237. If we lowered the required rate of return to the historical average for stocks, this high 400 stock would still be overvalued, showing a value of $391. And so you saw that steep decline in the stock price. And so nothing's set in stone. But I think that as Netflix becomes a story of a company that's consistently profitable on a quarterly basis, this is a stock where its intrinsic value will rise on a quarterly and yearly basis. The price will catch up, and it'll become more predictable with more consistent positive earnings and free cash flow. And you may have at a time in the future where the stock will trade higher and trade above its intrinsic value at times. But ultimately, in the long run, this is an investment I like. That's why I own it. So thanks for tuning in to another episode of Not Financial Advice.